Okay, well, welcome to Consumer Credit in America. We're extremely grateful that you're here, and we're grateful to Duke University and to Law and Contemporary Problems for working with us on this event. And we believe this is an important moment in consumer law in America. It's in flux. There's a dynamic state because at a federal level, the Consumer Financial Protection Bureau has been up and running since 2010, has returned more than $5 billion back to consumers, and now is aggressively pursuing regulation as well as enforcement actions. We've all seen Wells Fargo, and the CFPB has continued to really change the consumer credit landscape. And even states and municipalities have been passing legislation. I know in Texas, where I live, almost 40 municipalities have passed consumer credit law regulations, or I guess ordinances, to affect payday lending. And so there's definitely a large amount of regulatory change. And sort of going along with that regulatory change, business models and types of credit products continue to evolve at a rapid rate. I was thinking, if you thought 20 years ago you probably couldn't get a loan online, you certainly couldn't get it from individual people all across America funding that loan. And as we've seen, subprime mortgages may have faded away, but subprime auto loans have risen. And so both the regulation and the business are in a state of flux. But despite the dynamic environment that we're operating in, there are some themes that continue to emerge, right? There's the same sort of themes of access and opportunity for people who need to smooth consumption over time, but also the same themes of exploitation, that racism, that have been in our credit system for years and years. And so as we come to this moment, we think it's a critical moment for policymakers and academics to critically evaluate what role regulation should play in these products. And so that's the goal of our symposium today. And if anyone is up to the task, I really believe that it's this group of speakers. We have people from policy centers, people who've just emerged from working in government, and then a host of different types of academics. We have people from a wide variety of backgrounds and wide variety of preferences for how much government intervention there should be in these markets. And so I'm extremely grateful to all of the people presenting papers today for their involvement. And with that, we will start with the first panel.
And to Jim especially, the idea for the symposium was his. He got the driving force in getting this all. Jim. So our first panel today is about consumer credit and consumer financial protection. And given that the creation of the CFPB was possibly the most important we'll be discussing CFPB's powers to examine, to collect, and respond to consumer complaints. So Christopher Peterson from the Bourke and on one regulatory power, and then I will finish up the panel talking about consumer complaints and the narrative in particular. So, Chris?
Well, thank you. Let me first start off by also conveying my thanks to Professor Hawkins, Jim from the University of Houston for organizing the symposium, and also to the students and staff here at Duke University for hosting us. just to kick things off, I thought it might be useful to take a step back 10 years ago and think about where we've come over the past decade or so. Recall that in 2006, 10 years ago, we were just at the beginning of what was ultimately going to become the crash of the subprime mortgage market, and that spread throughout the world through derivatives and a host of other bank insolvencies and other problems. And in the Great Recession, approximately, and you get different estimates, but the one that I've been going with is 7.3 million Americans lost their homes to foreclosures or short sales. Nearly $11 trillion in household wealth vanished. And this had profound consequences. I won't go through all of them, but among some of them that are particularly poignant for me, the national suicide rate increased nearly 13% between 2005 and 2010. It wasn't just for adults. This profoundly affected children. Food insecurity increased by 35% from an average of 11.4 to 15.4% of households. So the notion that consumer finance is a boring business law-related area of the law, I think is mistaken. Consumer financial services are dangerous. If consumer finance doesn't work appropriately, people die and children go hungry. And that's why Congress created the Consumer Financial Protection Bureau in the Dodd-Frank Wall Street Reform and Consumer Protection Act. Well, by way of a disclaimer, I think it's accurate to give for both the folks in the room and also that may be viewing at home. I've just finished about 4.5, 5 years of working at the CFPB while I was on leave from my university. I just stepped down and returned to full-time teaching about a month ago. So I am invested in the project of the CFPB, and all of my remarks should be taken with a grain of salt. But my disclaimer is that none of the material that I'm discussing is confidential or private, and has not been influenced or suggested by the CFPB in any way. My presentation reflects entirely my own views and is based on publicly available information. So in particular, in addition to the CFPB, the creation of the CFPB, Title 10 of the Dodd-Frank Act also created a new prohibition of abusive finance. That's what my remarks are going to focus on today. In particular, this abusive standard added to what has been the long-held prohibition or the long-standing prohibition of deceptive or unfair acts and practices. These deceptive practices and unfair acts and practices have been illegal, as most folks that are involved in this area of the law know, since for many generations. Under the Federal Trade Commission Act, and the federal banking regulators have also had authority to bring enforcement actions based on those prohibitions. But one of the big innovations in the Dodd-Frank Act was to create this new prohibition of abusive acts and practices. And that abusiveness standard was greeted with polarized views in the industry and amongst academics and commentators. The late, great Gene Brockauer from Arizona University, who was I know a mentor to many consumer finance law scholars around the country and recently passed away tragically, she said that the new abusiveness standard was arguably the most exciting development in consumer protection since the 1960s. Right? That's a big deal statement from one of the country's foremost consumer finance scholars. But also on the other side of the sort of political or ideological divide, Todd Zwicky, a renowned scholar with a very law and economic orientation from George Mason University, said that the abusiveness standard is dangerous, will likely chill innovation, especially given the CFPB's tendency toward overuse of enforcement. And then practitioners that represent financial institutions, including Eric Mogilnicki and Mogilnicki and Moran, who some influential banking attorneys, they said that the Bureau's resistance to providing further clarity or defining the abusiveness standard is a missed opportunity because an infinitely flexible standard provides no guidance to covered persons and no permanent protection to consumers. So that raises the question that I'm interested in my paper. Has the Dodd-Frank Act's prohibition of abusive consumer finance measured up to either the hopes or the fears for this standard? And by way of overview, just a couple quick remarks about background and methodology, and then I'm going to present just a few results from a quantitative study that looks at 4 years of the CFPB's enforcement of abusive practices through the lens of some descriptive statistics and some notable findings, and then maybe looking towards the future. So by way of background, the CFPB enforces a whole host of enumerated consumer financial laws, including the Truth in Lending Act, the Equal Credit Opportunity Act, the Fair Debt Collection Practices Act, a variety of other statutes. But my work today focuses more directly on the CFPB's authority to enforce the prohibition of unfair, deceptive, and abusive acts or practices, or so-called UDAP authority. Title 10 prohibits all of these things, and it also prohibits covered individuals or companies from aiding or abetting through substantially assisting the prohibition, or substantially assisting those types of practices. Well, and in particular, looking at abusive, just reading out the abusive prohibition from the Dodd-Frank Act to try and ground us all, it's illegal now to materially interfere with the ability of a consumer to understand a term or condition of a consumer financial product or service, or to take unreasonable advantage of having a little bit of a hard time with my thing here. A lack of understanding on the part of the consumer of the material risks, costs, or conditions of the product or service, the inability of the consumer to protect the interests of the consumer in selecting or using a consumer financial product or service, or the reasonable reliance by the consumer on a covered person to act in the interest of the consumer. So this is what the statute says is illegal and how the statute defines what abusive acts or practices are. But how is that measured up? I mean, what has the Bureau actually done with that? My study takes a look at 122 publicly announced CFPB enforcement cases that ranged from 2012 to 2015, and then classified them based on a wide variety of variables, including total consumer redress awarded. Let's see if I can get this to work a little bit better. Civil money penalties awarded, enforcement partners, whether cases were settled or contested upon announcement, the type of company involved, and whether or not it was an enumerated statute or a UDAP theory that was enforced, as well as a variety of other potential variables. And just looking at it, the trajectory of the CFPB's enforcement actions, you can see over each year the number of employees in the line, and then the number of CFPB enforcement cases that were announced in the bar charts. And as the number of employees grew, you also saw a parallel growth in the number of cases. By 2015, the CFPB had 1,529 employees, and the Bureau announced 55 different enforcement actions. This chart also tracks the amount of consumer redress or consumer relief awarded to American consumers in public CFPB enforcement actions in the bar chart. And then also in the line, you're showing a characterization of the amount of money that was awarded per CFPB law enforcement employee. So if you look at the entire amount of relief that was awarded and then divide the number of employees, that's what you get in the line chart. And in 2015, the CFPB returned $6.425 billion to consumers, and this is relief awarded directly back into consumers' pockets, not penalties collected that the government holds on to, but this is abated debts, refunds, etc. And if you add that up based on each employee, that works out to be just under $10 million per CFPB law enforcement employee. Well, what kind of cases, what kind of products did the CFPB bring enforcement actions against? Well, the largest financial product or service that received the CFPB's attention was the mortgage market. 47 cases, which constituted 38% of the Bureau's docket and amounted to about $2.9 billion in consumer relief. Debt collection cases were the second most prevalent, with 29 cases constituting 23% of the CFPB's enforcement docket, and about $6.7 billion in consumer relief. Credit cards were next, with the largest sort of credit card cases returned $7 billion to consumers, and there were 21 of them over that 4-year period. Ancillary products that were sold alongside consumer financial services were a big part of the CFPB's enforcement docket. Debt relief services, there were 13 cases that focused on debt relief services. Student loans, as interestingly, was not that big of a part of the CFPB's enforcement docket, even though it's the second largest consumer financial services market, which is an interesting result. Only 6 cases over the studied time period focused on student loans, even though that's a relatively large market. And then some markets didn't receive any CFPB enforcement attention at all, including pawn loans and remittances. Well, this chart shows the different enumerated cases selected enumerated statutes that the CFPB brought enforcement actions against, and you'll notice that the total consumer relief in these cases is, by Bureau standards, relatively modest. The most, the Truth in Lending Act, for example, cases that pled violations of the Truth in Lending Act only led to about $306 million in consumer relief, which sounds like a lot of money for a private case, but for the CFPB, given the 10 to 11, $12 billion that it's returned to consumers, $300 million is a relatively modest portion. Much more significant was the CFPB's enforcement of deceptive trade practices. About $10 billion was returned to consumers over the studied period in deceptive trade practices cases, which constituted 93.2% of the total amount of consumer relief. So the large bulk of the CFPB's restitution refunds that were returned to consumers came in cases where the CFPB pled deceptive trade practices. But compare that with the abusive practices, cases that pled abusive practices. It turns out that only 1% of the total relief awarded in cases that pled abusiveness as a violation only returned constituted 1% of the total consumer relief awarded. So what this tells me is that the cases that pled abusiveness tended to be small cases that didn't actually, where were not a lot of consumers, and the amount of money at stake was relatively quite modest. Which is, I think, surprising given the level of controversy that was involved. I think I'm going to run a little bit short on time. This is just a list of the different abusiveness cases that were involved. And I think the takeaway point here is that it was the middle 2 of those prongs that where the CFPB most relied on in bringing its enforcement cases. And those are the prongs that, in particular, where the Bureau is required to show unreasonable advantage taking of the consumer. So some notable findings as I wind down. Well, deception rather than abusiveness has so far proved to be the Bureau's most important legal theory. 73 of 122 cases pled deceptive trade practices violations, while only 14 cases pled an abusive practice over the study time period. Approximately 93% of consumer relief was awarded in cases that pled deception, while only 1% of consumer relief was awarded in cases that pled abusiveness. And between 2012 and 2015, the Bureau did not accuse any banks of abusive acts or practices. Now, that changed recently after the study time period. Wells Fargo was accused of abusive practices in the creation of bank accounts and debit card accounts without consumers' knowledge or consent. And that was the first time in the entire 4 or 5 year history of the Bureau where a bank had been accused of acting in an abusive way. And it's also important, I think, after reading all the cases, that every CFPB case alleging abusive practices has also alleged some unfair and or deceptive act or practice. And oftentimes the abusive practices theories tend to look to me as though they are in some sense derivative of the same types of claims that we've seen in deception and abusive acts or practices claims. So then I guess maybe the takeaway point there is that the fear or the optimism over the abusive acts or practices standard, at least so far, has both of those have proven to be misplaced. So looking to the future and some challenges to consider for the Bureau and for commentators on the Bureau's work, it seems to me a key question is whether or not the CFPB's attentiveness to the Dodd-Frank Act restriction on the establishment of a usury limit, is that impeding the development of a jurisprudence on unreasonable advantage taking? So recall that in the Dodd-Frank Act, the CFPB was not allowed, as explicitly prohibited from establishing a federal usury limit or an interest rate cap. But at the same time, the CFPB has been charged with prohibiting any unreasonable advantage taking where consumers can't protect their own best interests. So query whether or not the effectiveness of the abusive standard has been inhibited by the fact that the CFPB can't establish a usury limit. Can you really, in consumer finance, prevent unreasonable advantage taking if there is a prohibition of any usury limit? So it seems to me that the Bureau needs to, if it wants to have a robust and innovative abusiveness jurisprudence, it needs to come to terms with what a usury limit is and what a usury limit is not. And then finally, is there a viable theory of abusiveness that cannot be ameliorated by enhanced disclosures or education? This is to say, are activities that are abusive even when the consumer, are there activities that are abusive even when the consumer understands the terms of the deal? Does abusiveness mean something more than deception? And with that, it seems to me that as we look to the future and whether or not someday we'll have another consumer financial services crash in the economy and whether or not we will continue to have meaningful consumer financial protection will depend at least in part on how the CFPB answers those questions. Thanks very much.
Thanks, Chris.
Great. I'm Angie Littwin from the University of Texas. Thank you especially to Jim and everyone else who organized this for inviting me. I'm about to present a paper that I finished, quote unquote, of Jean Brocker's after she passed away. And she was writing it for a symposium honoring Bill Whitford. The paper's already been published, but I'd like to continue presenting it because, as Chris said, she was one of the leading scholars of consumer law. She would have unquestionably been here today, so at least her ideas are here. For the symposium, she took Bill's article from 1981 called Structuring Consumer Legislation to Maximize Effectiveness and applied it to the CFPB's supervision powers. Bill's observation started from Bill's article started from the observation that was still true leading up to the Bureau's creation, that while there was plenty of consumer protection on the books, there was much less consumer protection in action. He laid out a series of hypotheses about what might promote consumer protection. He had three main hypotheses. First was statutory specificity. Right? Rules are better than standards because they encourage voluntary compliance, i.e. compliance in the shadow of enforcement rather than with direct enforcement. With vague standards, companies give themselves the benefit of the doubt. Of course, I'm not doing anything unconscionable. Whereas with rules, that it triggers companies' belief in being law-abiding citizens and harnesses their fear of bad publicity. But he argued it's good to have overarching standards as well, because to encounter situations that weren't thought of by the legislature or because practices change. His second insight was about the costs of compliance. Obviously, compliance costs matter, but his insight was to divide it into two types. One is direct transaction costs, and those are, the costs of writing news disclosures, for example, as they come out. For those, generally, the lower the better, right? Lower transaction costs help companies comply better, and that helps consumers. But there's also indirect transaction costs, which are essentially the substantive costs of compliance, right? The revenue that companies forego because the practice that is now illegal was making money. So for example, with credit cards, over-limit fees used to be charged all the time. With the Card Act, made them much more difficult, and companies sort of gave up on them. And according to the CFPB, there's been a $2.5 billion transfer from credit card issuers to consumers as a result of, in general. So that's an important insight about why consumer protection is so difficult, right? Indirect costs are in many ways a zero-sum game. Consumers gain as companies' losses, and it also means that companies are most likely to comply with regulations and rules that cost them the least. For example, the TILA disclosures. Everyone's happy to comply with those because they're probably not that effective in some ways. Final point was remedies. That then, as now, private remedies have never been enough to affect enforcement, affect deterrence. And his argument is that public agency is crucial for having real enforcement. And that within a public agency, the most important concern is its dedication to consumer protection. So this is a case study sort of applying those principles to the CFPB's supervision program. The statute, starting with the statute, it did set up a framework that's likely to lead to company consumer protection and company compliance. It meets Bill's best case scenario of broad standards backed up by specific rules, right? It has 3 broad statements of purpose of supervision, but then backed up by, as Chris mentioned, the 19 statutes or parts thereof that were transferred to the CFPB and the UDAP powers. Its practices also appear to be meeting Whitford's criteria for robust consumer protection. Most obviously, supervision is focused laser-like on increasing compliance with consumer law. That's directly on point. Specifically, the entire supervision process is about detecting and reducing the risk of UDAP and other legal violations. The Bureau, its whole life cycle of supervision depends on predicting risk of legal violations. So it prioritizes, for example, companies and products for examination by the risk of legal violations. So if you're a low-risk company or product, you're not even going to get supervision nearly as often. This enables the Bureau to stretch resources, which are its biggest constraint given the breadth of its mandate. And it also incentivizes companies not to engage in risky practices, right? Because not only will they have more favorable supervision, but they'll also have less of it. Second, there are several specific features of the Bureau process that are likely to increase consumer protection. The first is the Bureau's focus on compliance management systems, a term so prevalent it even has its own abbreviation in CFPB materials, CMS. It is designed to promote voluntary, again in quotes, compliance with consumer protection law, i.e. compliance in the shadow of enforcement rather than as a response to direct enforcement. The Bureau has set up the expectation that companies must prevent violations of law and associated harms without CFPB direct involvement. It also expects that compliance will go all the way to the top, involving senior management and members of the board of directors. And large institutions are expected to have a chief compliance officer with that person's own staff, an entire division. There's also, companies are required to have independent auditing. They're required to do their own processing, and then they're also required to have independent auditing of their compliance. So if the Bureau can convince companies to do this, that will vastly improve consumer financial protection and maximize Bureau resources, again, which are the largest constraint. Companies that are essentially engaging in self-supervision likely offloads a lot of the work onto them as opposed to the Bureau itself. Second, CFPB supervision is very, very thorough. They review documents extensively. From their examination manual, just to read you a list of documents: training materials, descriptions of products and services, disclosures, notices, agreements, periodic accounts and statements, written procedures and policies, minutes of board meetings and management committees concerning compliance. You get the idea, right? And there's more. So it's an exhaustive process. It looks at products throughout the life cycle, but pays special attention to new products, right? Examiners are to review documentation related to new products, that's marketing and media, scripts, and recorded calls. Next, its enforcement via supervision uses a variety of approaches. Christopher talked about the public enforcement actions, but CFPB also uses non-public supervisory actions and makes it a spectrum from the lightest touch of non-public supervisory actions all the way up through public actions. So the non-public actions, the lightest touch is making recommendations, which are simply suggestions to the institution. The next level up is matters requiring attention. which set a timeline for resolution and require a response to the CFPB. And then finally, the top level of private enforcement is private enforcement with monetary penalties. And in the Bureau's supervisory highlights, it will list an approximate sense of the violations, what industry was involved, what laws were involved, and the amount of restitution to consumers and financial penalties. Public enforcement is what Chris was discussing, right? The consent decrees. The Bureau does really effectively leverages publicity. When it publishes its private enforcement actions, it goes to great lengths to conceal the institutions subject to private enforcement. It will say one or more credit reporting agencies, because there's not that many, but it will also say one or more mortgage servicers, of which there are many, many, but that's still going to lengths to protect confidentiality. In contrast, the public enforcement actions come with press releases and more compliance bulletins, and the CFPB wants to get the word out. So that really does a good job of harnessing companies' fear of bad publicity. If you stay on the private side of the line, you're not going to incur the publicity costs. The spectrum of enforcement also has the potential to short-circuit companies' cost-benefit analysis in terms of how much cost will enforcement cost me versus how much am I going to gain from this practice that is now prohibited. Because the CFPB can increase enforcement to the extent necessary to engender compliance. But in addition to using this spectrum of enforcement, the Bureau early on did 3 early on public enforcement actions, which put the companies on notice that when violations are egregious enough, the Bureau will go straight to public enforcement, and the companies cannot count on warnings. This creates additional incentives for voluntary compliance. So overall, these supervisory activities set up the dynamic of the type that Whitford described for specific statutory commands, right? In addition to direct deterrence, the Bureau is harnessing companies' beliefs in being law-abiding and fear of bad publicity. But there are some potential pitfalls. A few ways that the Bureau's commitment to consumer protection could decrease. One, of course, is regulatory capture. I'm not going to go into detail about that. Everybody knows about that. And there has been somewhat of a revolving door at the CFPB. Second is a hostile presidential administration. If they don't kill the agency outright, could install people at the head of it who are hostile consumer protection. These are always a danger, but they're a particular danger with supervision. And that is because supervision is confidential. We wouldn't necessarily know it if the CFPB started supervising less rigorously. It could choose simultaneously to become less active and less forthcoming. And confidentiality is a key part of the process. There's voluminous internal information gathered. It's competitive information, including about new products. Revealing it would hurt consumers by hurting competition. Keeping things private encourages voluntary compliance. Companies are more likely to be forthcoming. Without confidentiality, companies be more likely to hide problems when the CFPB wants them to explain their problems, show their problems, demonstrate them, and show how they're fixing them. So it also reserves publicity as an enforcement threat. So there's good reasons, but it means that journalists, researchers, foundations, consumer activists, we can't know what is happening. A couple potential ways to address it. The main way the Bureau has been addressing this so far is by strong public compliance practices, which will hopefully set the norm for future administrations. It releases these documents, the supervisory highlights, that are this sort of fascinating blend of confidentiality and transparency. They're recommended reading. I find them really interesting. They describe the Bureau's findings, the practices it's concerned about, the degree of company compliance management, and any restitution that's required. But it doesn't name names unless enforcement rises to the level of public enforcement. So it gives you as much information as you could possibly get, I think, without compromising confidentiality. One drawback is the reports are not going to mention issues that the Bureau decided were not serious, right? So there's no way for outsiders to render judgment on those. Another possibility is for keeping compliance going is having the chief compliance officers within companies themselves. They may become voices for compliance within these organizations. I will end on a positive note, right? If future administrations don't kill the agency outright, there's some hopeful signs, right? The protective factors in the statutory structure are likely to continue to lead to a strong commitment to consumer protection, and the Bureau's current commitment to supervision suggests that we will at least have consumer protection during non-hostile presidential administrations, which is much, much better than we had before.
Hi, everybody. I'm Nick Bourke. I'm with the Pew Charitable Trusts. Pew is a large nonprofit organization, nonpartisan, and our main goal is to generate high-quality research that is relevant to public policy and helps improve public policy. I'm going to talk today about a very specific example, payday and auto title lending. This is an area where it's one of the Bureau's early forays into actual rulemaking. They've done a lot of supervision and enforcement and built up their system and capacity there. They're still relatively early in their actual rulemaking process. And I'm going to talk about a pending rule for payday and auto title and similar loans. If you're not familiar with payday and auto title loans, payday loans are small loans. They tend to be about $375 on average. They're usually due back in full on the borrower's next payday, which is typically about 2 weeks away. So you borrow $375 today. The typical fee is about $55 on top of that. You owe $430 on your next payday. Auto title loans are similar. Instead of having access to the borrower's checking account, which is how a payday lender sort of ensures that they're going to get repaid, they can reach into the borrower's checking account. An auto title lender holds the title to a vehicle that the consumer owns as effectively collateral to the loan. And auto title loans tend to be a little bit larger, about $1,000 on average, and those are typically due back in full after 1 month. Our bottom line in this area, and I should mention that Pew has had a small dollar loans project operating for over 5 years now. We've done deep research in this field. Our bottom line here is that there are deep harms, there are significant harms going on in the payday and auto title loan market that warrant regulatory reform. And the bottom line of what consumers need in this market is they need affordable payments and they need reasonable time to repay. There are others, and I'll touch on them. But regulatory response is definitely warranted and should try to achieve those goals. My agenda in my talk today is to talk about a little bit of the facts and research in this industry. I'm going to talk about the CFPB's pending rule. I'm going to summarize this rule, and I'm going to say our analysis of some of its shortcomings and some of the effects that it will have in the market. And then hopefully I'm going to tee up a few questions about the consequences and legal implications, and maybe we can talk about some of those. So a little bit about who payday loan borrowers are. There are about 12 million of them every year, and they're spending about $9 billion on these loans. Contrary to conventional wisdom, these are actually very mainstream consumers. In order to get a payday loan, you have to have a checking account. It's required to get a loan, so you're banked in the common parlance. You also have income because you have to get a payday loan, and that's usually from working. And people who get payday loans are not actually at the bottom end of the spectrum income-wise. The average payday loan borrower has income of about $30,000 a year, which equates to about $15 an hour. Also, payday loan borrowers are what we refer to as thick-file consumers, meaning they have a lot of experience with credit. These aren't young people or immigrants trying to strive their way into the credit system and learn how to use credit and get into it. These are people who have used credit and are failing out of the system. The typical payday loan applicant has a credit score, a FICO score of 517. And if you know anything about how that system works, that's bottom of the barrel. It means they're not going to qualify for any other type of mainstream credit. If you want to get some more of these types of facts, I'll refer you. We have tons of it on our website. One thing worth noting is that the reason why people get payday loans, by and large, is just to get by. People are living paycheck to paycheck, and what we have found is that 7 out of 10 times when somebody first gets their payday loan, the reason they're getting it is because they're trying to get help to pay a bill. A regular recurring expense like mortgage, 41% of them on homes, a credit card payment, more than half of them have credit cards, but they tend to be maxed out, rent, utilities, these types of things. It's rather seldom that somebody goes to get a payday loan exclusively because, or specifically because, the car broke down or they have an unexpected medical expense. It's really that people's lives are difficult financially and volatile financially. And income volatility is a really interesting area of the research where we're getting to know a lot more about income volatility in American households. And amazingly, almost half of US households are what researchers would characterize as income volatile, meaning their income is going up or down by greater than 25%, even from month to month. That is astounding. And I think what explains a lot of this is that there are a lot of people who are hourly wage earners. And if you're an hourly wage earner working at a factory, retail, or restaurant, oftentimes your schedule is unpredictable and it changes a lot. You get 30 hours this week, you get 45 hours the next week, and it goes back and forth. And so your income, of course, varies accordingly. It makes it more difficult to budget. It means from time to time you have gaps. So just to illustrate that a little bit, some research shows that typical household will have more than 2 up months and more than 2 down months in any given year. And so your income over the course of the year might look something like this. Now, if you're a typical payday loan borrower and you're making about $30,000 a year, that breaks out to about $1,250 every 2 weeks. So if you're paid twice a month, you're getting about $1,250 every 2 weeks. Now, if your income is volatile in this way, it could be going up or down by more than 25%. That's more than $300 up or down from paycheck to paycheck. So it's easy to see how a lot of households get themselves in this situation where they need $200 or $300 or $400 just to pay a bill. And this means that credit also can help. Credit can help this situation for some people, but the credit can only be helpful if it's structured a certain way. And I can tell you that the way that payday loans and auto title loans work today, it is not helping most people. And the core reason is that when a payday loan comes due, or a title loan, it comes due in full, in one big lump sum payment. The lender takes the whole thing out of the borrower's checking account or requires the borrower to come in and pay the whole thing off. Typical payday loan payment of $430 when it's due in 2 weeks on the next payday takes up 36% of a person's paycheck, even before taxes. Now, imagine any of us losing 36% of our next paycheck. It would be hard to make ends meet, I'm sure, for most of us. For somebody living in this situation where they went to get a high-cost loan in the first place to get help paying bills, it can be devastating. And so the borrower goes back, pays the loan because they have to, because if they don't, the lender will just take it out of their checking account. And then they pay a fee and take the loan right back so that they can go pay the rent or pay the mortgage. This is the cycle of debt that people often talk about. This is only made possible because of what the CFPB has termed the leveraged payment mechanism. The leveraged payment mechanism is the ability to reach into the checking account or repossess the vehicle title in order to enforce or ensure repayment. This brings us to the CFPB's proposed rule, which is open for comment right now. The comment period ends on October 7th. This proposed rule would cover covered loans as defined by any loan that lasts less than 45 days, so that's going to be your conventional payday or auto title loan, or certain high-cost installment loans. And that means a loan that lasts longer than 45 days where 2 key conditions are met. The all-in APR, so this is the annual percentage rate inclusive of interest and any fees that are involved, is greater than 36%, so they've kind of coined that as high cost. And the leverage payment mechanism is present, so the access to the checking account or the vehicle title. They've carved out certain things like overdraft and credit cards, but for the most part, this covers the entire payday and auto title and high-cost installment market where the lender has a leverage payment mechanism. This is lender agnostic. It will cover any lender of a covered loan, including banks and credit unions. Now, don't freak out. I know this is impossible to read, but what I want to just impress upon you is the way that this rule works generally is it gives the lender a choice of how to comply. The way that this table is laid out, on the left side are your short-term loans, less than 45 days. On the right side are the longer-term covered loans, greater than 45 days, high-cost leverage payment mechanism. The top row is the core part of the rule. The CFPB says if you're going to make a covered loan, you have to conduct an ability to repay analysis. You have to make sure that you're evaluating the borrower's financial condition and you are making a quote-unquote reasonable determination that the borrower can pay this loan according to its terms. The bottom part, the bottom row, is a number of conditional exemptions. The CFPB says you don't have to follow that core process if you follow some relatively more prescriptive rules about the way that the product looks or the way that you make that product available. I'm going to focus on what we've labeled box 3. It's the upper right-hand section. It's the core ability to repay rule for covered installment loans. Now, before I kind of explain how all that would work, impacts of the CFPB rule. It will strongly encourage an installment repayment structure. The payday and auto title loan markets are already have become installment loan markets. That's the future of payday and auto title lending. This rule will not eliminate payday or auto title lending. It will not eliminate high-cost credit. 400% APR loans are here to stay, but they're going to be installment loans and lines of credit. The rule discourages, in many ways, safer and lower-cost alternatives because it makes it difficult for mainstream lower-cost lenders like banks and credit unions to get into this market. Now, here's what I mean by high-cost installment loans thriving. The orange states, and there are 28 of them, are where payday and title lenders are already making installment loans or lines of credit of the type that would qualify under this rule. The dark green states are states that have Credit Service Organization Act laws that lenders are starting to use in order to evade existing state protections. And the light green states are where payday and title loan stores don't operate today, except for Arkansas and Maryland, which were restrictive states, but just in the past couple of months, the payday and title lenders have gone in there. The Bureau, and I'm short on time, so I'm going to kind of skim through this quickly, but the Bureau sort of has some shortcomings here because they don't actually regulate the leverage payment mechanism in any significant way. They're very focused on the ability to repay process, the process of evaluating and underwriting the rule. They don't put limits on this very powerful leverage payment mechanism. And the leverage payment mechanism is inherently dangerous. Ironically, it's the only reason that credit is able to flow to this type of customer with a 517 credit score. The lender needs that leverage payment mechanism in order to ensure they're going to get repaid. But inherently, having access to a checking account or a vehicle title is dangerous to a financially fragile consumer who's living paycheck to paycheck and is in many ways desperate to get this credit. The ability to repay process basically works like this. It requires the lender to pull a credit report to verify official debt obligations like mortgages or credit card payments. And then it requires the lender to estimate everything else. Housing, if it doesn't show up on as a mortgage on the credit report, food, utilities, transportation, and other living expenses, which is not defined. The formula is pretty simple. Figure out the remaining income after all those expenses are left, subtract those formal debt obligations, subtract quote-unquote other living expenses. That's the amount of payment you can take. I don't really have time to go through this, but what this is showing you is that for a typical payday loan applicant, the Bureau is estimating that they have $689 of remaining income before they pay off their credit card bill and before they pay quote-unquote other living expenses. So $689 after they've paid the mortgage, after they've covered all of their food, all of their transportation, all of their basic living expenses. That's kind of the range of field that the lender gets to play with. And it's not even just based on the average. If you look at available estimates of what that household has, at the 90th percentile of expenses, that household would have $218 in remaining income. At the 10th percentile of expenses, that household would have $1,611 in remaining income. That range is far too wide to be effective, and it's far too crude based on available existing average data about consumer remaining income. So the point here is that widespread harmful loans are going to stay on the market. Now, a lot of the lenders are happy about this, actually. They like these sort of vague standards. The largest payday lender called it a win-win. Their loan is a $1,250 loan, a little larger than an average payday loan, where the monthly payments are about $370 a month. You pay $3,700 total to pay that $1,250 loan back. Here's an example of a loan that we're seeing popping up on the opposite end of the spectrum, where the lender has structured it to be a very small loan that lasts a long time, $300, 18 months, $49 biweekly payment. That's going to fit within an ability to repay standard very easily. So it has those shortcomings I mentioned before. It's going to be difficult to enforce because it's going to be daunting to enforce because there are no clear standards. And these are fragile borrowers who are going to continue using the loans. I am short on time, so I will just mention that there's a flip side to this too, where the rule is trying to whack the bad guys, but it makes it really difficult for the lower cost lenders to get in. Banks and credit unions don't want to get into this market unless they can do it with some clarity, because there's a lot of regulatory risk and they have low appetite for regulatory risk, whereas payday lenders have high appetite for regulatory risk. And I'm going to just mention these consequences really quickly because I want to tee up some discussion on this, hopefully. At the end of the day, unless the Bureau kind of strengthens this rule to be better at whacking the bad guys and be a little better at letting lower cost loans in that actually save people a lot of money, the consumer benefit is dubious because of this rule. And that makes it difficult, whereas the cost to lenders is definite. That makes it difficult for the Bureau to justify this rulemaking in the face of what are going to be very, very aggressive challenges from opponents of reform. The cost-benefit analysis is going to be difficult for unfairness purposes, and proving abuse and stopping abuse is going to be difficult. Thank you. I'm sorry I went long.
So thank you all again for coming. So about a year ago, this flyer arrived at my law school office, and I put it on my desk. I took a picture of it. And the flip side says the exact same thing in Spanish, and it's about this big when you look at it, and I pass it out to my students sometimes when they come into my office asking about consumer protection and consumer credit. And when I got the flyer at that time, as I knew and as most of you probably know, the CFPB has a complaint function whereby consumers can submit complaints about particular products or services that are under its regulatory structure, and in the course of submitting their complaint, write a narrative about the problem they are having, which is sent directly to the company. So my broad project and the paper that I'm putting together for this symposium focuses on the narratives written in conjunction with that complaint function. But it was this flyer that got me thinking about the place of writing a narrative in the CFPB's broad goals of advancing consumer protection. So I want to talk a bit about the Tell Your Story feature and how it fits in with the complaint database. So a bit of context. This is a snapshot of the webpage of the Tell Your Story from the CFPB's website. And it has, as you can see, as I've circled in red, a prominent place that sends consumers to the complaint function. And it's part of the CFPB's broader goal of hearing consumers and also allowing consumers to hear each other. And so if you don't want to submit a complaint, you can tell your story, but they really would like you to submit your complaint. And so if you go to the Submit a Complaint website, you basically come up with this front page. It sends you in the red box back to Tell Your Story, although it's a little less prominent, and also directs people to the complaint database if they want to read about what other consumers have said about their experiences. But otherwise, they can pick a loan, a product or service they're having a problem with, click on the link, and then get a web form that allows them to check some boxes, many boxes in some instances, few boxes in other instances. But all of the web forms include a very large space where consumers can type in what problems they're having and their other experiences. And so the complaint database is where I get my data from. This is the front page of the complaint database, which is also where consumers would go if they would want to see what other people are writing. And of note, the CFPB says that reading consumer narratives will allow others to learn from the consumer's experience. Again, please let us know what's going on. And also, importantly, help the CFPB improve the financial marketplace. And though the CFPB began taking complaints basically the moment it opened and started publishing the database in June of 2012, it wasn't until June of 2015, about a year ago, that it started publishing consumer complaint narratives for kind of public use and public consumption. And the narratives are, just to give you an example of what a narrative looks like, what I would call straight from the consumer's keyboard. This is what a consumer would see, but they'd see a bunch of them lined up if they were to put the narratives and the complaints right onto their desktop or their computer. So consumers must consent to the narrative being published. It is scrubbed of any personal information, and more often than you might think, offensive or seemingly offensive language. And sort of that was my entree into what people are thinking. More than half of the people who submit complaints online say that their narratives can be published, and the people who submit complaints online are about half the people, a little over half the people who submit complaints in general to the CFPB. But in total, that amounts to 5,000 complaints with narratives published online per month. And because the CFPB only recently began publishing these narratives, they haven't really been assessed and addressed on a systemic basis, which is what I aim to do for the symposium, and which has turned into a much broader project because, as you can see from just one of these, there's a lot to work with there and a lot of ways to think about the data. So what I want to do for today is describe the data and what I think the data suggests, and then get your feedback on what I have and where I might go with it, and what you think it also is showing, or other avenues I could go down with it. So I want to talk about what I think it suggests about how people are using the complaint function to first voice their problems and then to ask for the CFPB's help in a variety of ways, which can be thought of as an expressive element of the complaint function. And this expressive element has been brought up in prior work about the complaint function in general by Katie Porter and also by Angie Littwin, but it was mentioned in passing in prior articles that really focused on consumer protection. So then I want to take that and see how it aligns with the CFPB's role in taking and processing complaints, and then what it suggests about how the CFPB could tweak how it addresses the complaints, and for the general advancement of consumer protection, which again is the main question raised in prior articles and is the CFPB's main goal. So quickly, beginning with my data. What I did was I downloaded every complaint with a narrative that was filed in the year period between May 1st, 2015 and April 30th, 2016, which is a total of about 23,000 complaints with narratives. At that point, I took a random sample of 20% of them because I wanted to actually read what the consumers were saying at least once I had done a first sweep of the coding. The table on the left of the slide breaks down my sample by product. And it was the best way I could think of trying to get, is this a relatively good sample of the complaints that the CFPB is getting overall? So the table on the left, or on the right, breaks down CFPB data about complaint volume by product for 2014 and 15. And as you'll see, there's slightly more complaints about mortgages and slightly fewer about credit reporting and payday loans, which might be a function of who has access to the internet and the ability to write a complaint, and also who's going to check that box that says, yes, you may publish my complaint. To move on to my empirical strategy before we tee up what was going on, one of the goals I had was to assess how people are telling their stories and how they're voicing their problems. So what I did was create a primary coding scheme based on major emotions expressed through the narrative's language. And there's a whole emotions and law work scholarship that I pulled these emotions out of. And these anger, sadness, fear, disgust, shame, and guilt are 6 of the major emotions. And as I was looking through the narratives, I realized that it might make sense to break out what I call frustration, which is not an emotion, but it's anger light, something short of the first narrative that you saw where there is clearly anger and words that trigger anger in the narrative, yet there still is a frustration expressed by the consumer, as compared to this other clip of a narrative that I have on the slide, where the consumer is simply saying, hey company, I never lived here, I never worked here. There's really no emotion in this narrative to code in the way that I coded it, and about half of the narratives say things like this, and the other half of the narratives are representative of the first narrative you saw, where there's clearly a big story going on. So once I did that, I got this table. The emotion and the sample of narratives with that emotion expressed through the language. This table tells you nothing at all. What is more interesting is to go to each of the narratives and read what the consumer is saying, and then to see what is going on with them. So when the narrative expresses anger, frustration, and to a lesser extent, disgust, which doesn't come up all that often, the consumer story is about the company and how they're being treated by the company, and they're really speaking kind of to the company, or in some instances, yelling at the company. But when they express sadness and fear, which comes up more often than you would think, they're not really talking to the company, or they talk to the company for a line, and then they move on to essentially a very sad story about how their problems with the company have intersected with their lives and impacted their lives. So they focus on their inability to provide for their family, such as food. There's a whole lot of talk about not eating, and problems that have affected them medically, physically, and mentally. So at this point, a more rigorous qualitative or quantitative content analysis would be one avenue to pursue, and it's something that I mean to pursue. But I decided at this point that's for another paper. So instead what I did was I added a layer to the analysis that speaks directly to the CFPB's role in processing these complaints. So what the CFPB does is forward the complaint to the company responds, and then the consumer can respond to the company, and the CFPB also looks at the complaints to figure out some enforcement and otherwise regulatory efforts. So what I looked at was, did the narrative evidence what I call deference to the company, saying, please help me, let's have a dialogue, with what I mean by deference. Did the narrative evidence deference to the CFPB? Same thing, please help me personally with my problem. Did the narrative mention a legal claim, and did it mention bankruptcy? So this slide in this table shows what I call coming to law, using the narrative space to say, hey company, you are violating a federal or state law, and also, hey, I filed for bankruptcy, or I'm going to file for bankruptcy. Bankruptcy sort of falls out of the analysis here, because I think when you look at the percentages that mention bankruptcy, you have people's thoughts about what it means to file for bankruptcy, not what it means to file a complaint. However, if you look at frustration and anger, you see those are the ones that mention law. So it seems like if people are turning to the narrative space and to the company, they're more likely to say, hey company, here is the legal violation or a legal claim that I would like to raise, and this is the avenue that I'm going to do it in the first instance, which is actually probably one of the benefits of the complaint function. These are people that don't have the time, money, resources to raise the claim to begin with. And whether the claims are dealt with in the process is an open question, but for now I'll just note that. And then contrast it with narratives that ask the CFPB for personal help, which intersect way more with sadness and fear. So what you have is, if a narrative has a sadness note in it, and language that talks about how basically awful their lives have become, 24% of them say, please help me personally, CFPB, right now. I need help from you. Versus 9% with anger, 13% with frustration. You can look at this also from if the consumer is asking the CFPB for help personally, what percentage of those have a certain emotion in them. 20% have no emotion, but again, sadness and fear stand out. And this is language imploring and pleading with the CFPB personally for help, not simply, thank you for your time and consideration, I like what you're doing, or in the case of PayPal, after the PayPal rule and an enforcement action was announced saying, hey, CFPB, you didn't do enough, you should do more to help others. That's tagging the CFPB to do something with its regulatory and enforcement functions, not help me personally, which has nothing really to do with what they're going to get from using the complaint function in the first instance with the database. So quickly, what does this all mean? This is where I need the most help. I think what the narrative language shows is two completely separate ways that consumers are using the complaint function. First, there's the batch, and it's a bigger batch of consumers that are expressing anger and frustration with the company and saying, this is the way that I am going to be able to speak to you in the first instance. Please, company, sort of help me. And the benefit of telling that story, and then also along with these narratives, saying to the CFPB in a broader way, hey, maybe you should look into this company for the benefit of all consumers, can't be underestimated. And also importantly, it tracks with the function of the CFPB's complaint database and processing mechanism. However, if you take sadness and fear as proxies for telling your story about the impact of credit and debt on your life in a broader instance than just what the company has been doing kind of to you or how you perceive the company is treating you, and then adding on that consumers then plead with the CFPB to make sure that they have food and otherwise are able to live their lives. If they don't receive the assistance that was contemplated from the CFPB, they might become disillusioned, which could sort of backfire with what the CFPB's function is with the complaint database and taking the functions or taking the narratives. And also, this might, I think, offer an avenue for the CFPB to start focusing on which companies' enforcement actions might be worthy of being prioritized, or at least looking to first in terms of what companies, what products are intersecting with people's lives in a way that is making them reach out through the narratives personally to the CFPB. And so with that, I am out of time, and we will move to kind of question and answer period. So as moderator, I would like to take a light moderation role and see if anyone in the audience first would like to ask any questions of anyone. Paige?
Yeah, thanks. Paige Skiba from Vanderbilt Law School. Thank you so much for this panel. Really fascinating unpacking of what the CFPB is doing. A couple of questions first. I guess for Chris, I wanted to ask you what you think Wells Fargo tells us about how it fits into your analysis of the future of the CFPB's deceptive and abusive enforcement actions. And then I guess for anyone, it's been a really interesting week for the CFPB, their public enforcement actions. For those of you following the Payday world, the CFPB had a very public enforcement action against LendUp, which is pitched itself as sort of a nicer, friendlier payday lender. So that was a very public enforcement action against a company that many of us thought was one of the good guys. So I wondered if any of you had thoughts about what that might mean for smaller companies trying to work in the consumer credit space.
Well, I mean, first off, with respect to LendUp, I mean, my recollection is there was a $9 million penalty. So in the grand scheme of things, you know, that's not that much money. I mean, it's not, that's not a big case. On the other hand, the penalty in the Wells Fargo case was $130 million, a much larger case, many more people affected. And I guess I would resist the sort of impulse to say good company, bad company. The question is whether or not they violated the law and whether or not the facts show that they violated the law. And it does look like LendUp, which may be a good company, may not be. That's not wasn't the job of the Bureau to decide that. The question is whether or not they violated the law. And the scale, my recollection is that the scalable, they had this slide bar that they used on their webpage, and I think it violated the Truth in Lending Act, and there were some potentially misleading practices that they engaged in. But that doesn't necessarily mean that LendUp doesn't have a lot of things to offer, and may not, may be a good guy, as you say. And I think also too, if you take a look at that press release, I think that and compare it to maybe some of the, I mean, if you read a lot of press releases, as I have, doing this study. The Bureau pulled its punch on that press release, I think. It could have spoken much more harshly about LendUp than it did. So maybe, I don't know if that makes you feel any better about it. And your other question was about what the Wells Fargo case says about the future of the Bureau. Honestly, I don't really actually think that the Wells Fargo case is that interesting legally. That case is interesting because Wells Fargo is one of the largest financial institutions in the world, and it's troubling to find out that thousands and thousands of their customers or their employees were just engaging in naked fraud and identity theft. That's what's troubling about that case. It has an echo of the financial crisis, just as some of the largest financial institutions in the world were underwriting mortgage loans, pay option, hybrid, interest-only, exotic mortgage products without any documentation, nakedly committing fraud. It turns out that Wells Fargo was also doing that in creating bank accounts that the consumers did not agree to. But that's illegal. It's always been illegal. It's not interesting legally, therefore. It's only interesting because of who the defendant was. So whether or not the Wells Fargo case is interesting, I think we're going to have to follow the Bureau. Actually, I have to stop saying we. The Bureau will have to follow the facts on that. If other financial institutions are doing what Wells Fargo did, then that may signal something about what's likely to happen in the future. But if other financial institutions are carefully monitoring their cross-selling, incentivization packages for their line employees in their branch distribution, their distributed branch networks, then I think that the Wells Fargo case is not going to be, a harbinger of things to come.
Mirza? Yeah, so I've been, I'm very curious about this. For Nick, I think, and Chris to some extent, but this idea that payday lender, the payday borrowers are not using these loans for unexpected expenses, but for regular run-of-the-mill. And I think the data's sort of all over the place on this, right? So some people who've studied it say, yes, it's an unexpected expense, and some people say, no, they're just using it to pay their rent. So I want to get at, first of all, what is the methodology that you're using? Are you asking people what they're using it for? Are you actually sort of, looking at their finances? Because I wonder could you be taking out a loan because there was an unexpected expense, but to pay your rent, right? So the money is actually going to pay your rent, but the reason why you have this $500 shortfall is because something happened this month. And whether it's even possible to take out that sort of exogenous factor that is causing you to take out the loan. So, and maybe that, I think everyone who studied this comes out differently, and maybe it depends on what you think about payday loans, right? It maybe makes it more, you can be opposed to them if you think that it's an unexpected expense versus that you're taking it out to pay for general.
Yes, obviously, that's happening. Some people have an unexpected expense and they pay it, and then they can't pay their rent, so they go get a payday loan. Obviously, that's happening. The point in us drilling in on it the way that we did. And we did this initially through 22 focus groups throughout the country over the course of a couple of years to kind of hear people talk about it directly and ask them questions directly. And then we did a variety of survey work, nationally representative random digit dial telephone polls of payday loan borrowers, auto title loan borrowers. We wanted to dig in and ask the question many different ways, and sometimes in ways that hadn't been asked before. Because what we found was, if you talk to somebody in a focus group, why'd you get that payday loan? Oh, it was an emergency. Oh, tell us about that. Oh, I couldn't pay my rent. It was the second month in a row I was past due. It was an emergency. Now, a lot of the previous research had been like, why did you get this loan? Was it an emergency? Yes. That doesn't tell the whole story. So we just dug in and asked a very simple question. When you got this loan, what did you use the money for? And 7 out of 10 of them said it was for some kind of a bill. Now, yes, sometimes they're getting the bill because they had an unexpected emergency and they couldn't pay the bill. But I think the bigger picture story there, and I think what really I think we all agree on mostly, is that the reason why people are getting payday loans is because their lives are financially difficult and messy, and they get knocked off balance really easily when they have a mistake or bad luck or an unexpected event or their hours change. Like, that's really the narrative that I think we all agree on. And that's why we have come to the conclusion that credit can help people in those situations, but only if it's structured a certain way. And that means it has to have an affordable payment that takes only a small percentage of their paycheck, not 36%. Most borrowers can't afford more than 5 in our research. It needs to last a reasonable amount of time, not 2 weeks. But that $300 loan I put up on the screen that lasts I think it was 18 months, it's crazy. $500 about 6 months is the right time to pay it off. I mean, policy should be pointed towards getting us to that position because that's what leads to better consumer outcomes.
Sarah?
Just to follow up, did you look at states that don't have payday loan operators, and what are people doing there to smooth? Did you survey in those states, or
Yes.
And what did you?
Well, our survey work doesn't answer that question. I can really answer it more qualitatively with focus group findings. The way that I think about it, and I think this is reflective of reality. Some people in our focus groups sort of told the story like this. I'm trying to solve a problem. I'm not shopping for credit when I get a payday loan. I'm trying to solve a problem. And so we talked to some people in New Hampshire, for example. They used to have payday loan stores. We got some people who used to use payday loans. Now they don't have the stores available. We said, what do you do now that you don't have the loans available? They're like, well, I'm trying to solve this problem. So I need $400 to pay my mortgage. I could ask my dad. I could sell my stereo. I could not eat dinner 3 nights a week. And we said, okay, well, which one of those do you choose? They say, well, all of them. I'll get $50 from my dad if I can. If I can't, I'll sell my stereo. If I need more money, I won't eat dinner. I mean, the payday loan is just another option on the table for people who are trying to solve a problem. If it's there, they'll use it. If it's not there, they'll use the other stuff. And that's part of the reason why I say in an examination process, it's really hard to see where harms occur. Like, not eating dinner 3 nights a week doesn't show up on a credit report. Not buying clothes for your kids doesn't show up on a credit report. Examiners don't see it when necessarily when you sell your stereo or you forgo maintaining your home or something like that because the loan's taking too much of your money.
Yeah, I'd like to get your thoughts. When Dodd-Frank was being drafted, it went back and forth with CFPB being run by a 3-person panel, 5-person panel, and finally got to a single administrator. What are your thoughts on if it would have originally been enacted a 3-person panel? And I know there is some legislation pending to make it a 3-person panel to oversee the agency.
So this is the sort of question that for 5 years I've dodged and I had a good excuse not to. I guess that my first comment is that a lot of whether or not that's a good idea depends on whether or not you get somebody to run the show. And over the past 5 years, they have this guy named Richard Cordray, who was my boss for the past 2 years, and he is, in my view, one of the most astonishing and remarkable human beings I've ever met. The guy is sort of genius level performer, has attention to detail and recovery, and his ability to process information unlike just about anyone I've ever met. And he has unimpeachable integrity and honor, and has a high emotional, EQ guy. He's just a remarkable person. And so my sense is that if you get somebody that does a good job and is thoughtful, has integrity, approaches the project with the thoughtfulness that it requires and the competence that it requires, that individually led organization is more efficient because somebody is accountable and can actually get things done. The problem with commissions is that they split and deadlock, and that's why oftentimes, I don't mean to cast aspersions, there's a lot of wonderful people at the SEC and also the Federal Trade Commission, but I think that if the criticism that has been leveled, not by me but by others, is that they oftentimes are a little bit hesitant perhaps, or maybe not sufficiently assertive in their enforcement actions, and their reform work becomes stale and the industry goes around them and creates new products and things that are not deterred. So the downside of commissions is that they can be inefficient. But that being said, in the Trump administration, perhaps a single individual director could be particularly harmful to the consumer interests that the agency was created for. So I think there are risks and benefits from both sides, and I think that the importance of actual individuals and their sort of capabilities is undervalued in that conversation. My view.
Richard?
So I was curious about the enforcement actions. If you look at, you categorize them by the nature of the claim, and obviously it adds up to much higher than 100%, right? The deceptive plus the unfair were basically the same number. And what I'm curious about was whether the UDAP claim, I guess I have to add an extra A in that somehow, but the UDAP claim was an add-on claim, whether adding it on to TILA or something else, or how often it was independent, in the sense that, the other consumer statutes can be extremely technical, right? I don't know anything about the lend-up scenario, right? But whether it's certainly possible for somebody to violate a consumer statute and not be a quote-unquote bad guy, right? In the sense that you could format your form incorrectly, nobody reads them, you don't need to show reliance to show a violation of the statute. So how often are they sort of tacked on, the deception tacked on as just an additional claim, and how often are they independent?
Well, I think that calling the UDAP claim the tacked on claim may be kind of getting it backwards. I think that so there was that chart that I showed, and there's some other charts in another piece I have coming out that maybe are a little more illustrative on this point, but there was the chart that I showed that looked at enumerated claims, and you'll just, the thing I highlighted was that the total amount of consumer relief and redress in those cases is actually quite modest in comparison to the UDAP claims. So if you just look at the array of cases that are out there, there are just a larger number of UDAP cases, and they're producing much more in return. But in most of the cases, you're going to find a mixture of enumerated claims alongside the UDAP claims, but not in all. And there are definitely some cases that are UDAP only. It's an interesting question. I should have tracked to see whether or not there, and could go back and do it and see whether or not there are any enumerated only claims with no UDAP. Off the top of my head, I think the only ones that I can think of, there may have been some Equal Credit Opportunity Act fair lending cases that didn't have UDAP claims attached to them, and I think that may be the only example. Hopefully that's responsive.
Jean?
Pamela, this question is for you. So when I was looking at the complaints that you were talking about, I kept thinking intentional infliction of emotional distress, and I know you talked briefly about that some people are seeking legal remedies. I was curious, do people ever get any monetary compensation when they have a complaint? I know the example you said that they weren't in debt and debt collectors try to collect debt. Is there any compensation for their emotional distress that the company gives? And if not, do you see maybe the CFPB taking some sort of role to facilitate some sort of compensation if the company is getting it wrong?
So in terms of the role of the CFPB with the complaints, and which is sort of, it goes along with telling the stories and how these narratives and people are interacting with the function, the CFPB sends the complaint to the company. And it's very clear. Like every homepage now, the first line you read, usually in a box, says, hey, we're going to send it to the company. The company has 15 days to respond to you, and then you as consumer can respond to the response effectively. And the complaint database itself has what the company said and the sort of result of the complaint in very broad categories. So we'll say it was settled with monetary relief, settled with non-monetary relief, company disputes, and then there's a few other things. That's the only markers in the database, and I didn't really look at it for that. I was more looking at, do people understand what they're doing? And when they don't understand what they're doing, what does that, how might that affect the CFPB's role in processing these complaints, and how might the CFPB in turn look at what people are saying to figure out how to allocate its resources to enforcement and regulation, because part of taking the complaints is to look at what people are complaining about. And in the paper, I use PayPal as an example, and there's a whole lot of narratives about PayPal before they did something, and there's narratives about it after. And so I think you can track activities of the CFPB with what people are saying. But in terms of, we don't really know what the end result is. And maybe Angie could speak more to this, which was one of your papers about the end results.
Yeah, the end results are, so the companies provide relief, and that's where the database stops. You see whether the consumer disputed, but you don't see if the CFPB intervened after the dispute, and you don't see if the company resolved the problem after the dispute. In interviews with CFPB officials, I got the impression that if consumer disputed, that was likely to get Bureau to pull that complaint and actually look at it, but it was not completely clear. I will say that the relief that was granted, if you break it down into product and subproduct, relief is most likely to be granted when it's smaller and when it's less meaningful. So for example, credit reporting agencies have the highest rate of granted relief, and the highest thing that they get relief granted for is help obtaining your credit report. Right, so that's an example, right? Credit reporting agencies' credit cards comprise almost like 45% of the relief when they're a small percentage of the claims, whereas mortgages comprise like 40% of the complaints and provide much less of the relief, and obviously that relief would be more meaningful.
Jim?
I had a question for you as well, Pamela. I was wondering whether or not it was hard to code the emotions, or if there were, I guess, were there a lot of things that were on the edge between anger and frustration, and if you thought of any research strategies to minimize coding errors.
Yeah, so the way, I didn't really have time to go through it, and I'm still sort of working through it again. There are dictionaries of words that are basically synonyms for these emotions. Clearly synonyms for the 6 main emotions that I use, and those were the ones, and you can actually have a software initially code it for you. And that would be more of a qualitative, quantitative content analysis. And so that's what I and my research assistants did initially with the emotions expressed in the narratives. Look for actual words, and disgust was actually an easy one. Like, consumers say, I am disgusted, right? And then there's a few synonyms for disgust, there's a few synonyms for anger. But as we read the narratives, we realized that some of them are, there's anger in there, there's lots of exclamation marks, and those are the ones that we tagged as frustration almost manually. But if you take frustration out of the analysis and just go with the pure anger, you still see the same 2 type of narratives coming through. And I think that's, absent a even more rigorous way of doing it, that is how we went through and did it.
Could I ask a question?
Yeah.
Chris, you mentioned something I found really interesting, and I'd like to hear you say a little more about it. A number of things, but specifically one. The lack of the Bureau's usury power gives rise to the need for them to kind of explore that more, and we need a jurisprudence, development of jurisprudence on unreasonable advantage taking. That really rings true to me in many ways. I'd like you to say more about that.
Well, so recall that in the abusiveness standard, 3 of the 4 potential prongs contemplate one of the elements of an abusive claim involving some form of unreasonable advantage taking, and it's not clear, it's not defined beyond that. But to my way of thinking, unreasonable advantage taking, one thing that might tend to show that would be price gouging, or taking too much, taking in a form of compensation that's unreasonable. But at the same time, the Bureau can't establish a usury limit. It seems to me that a usury limit, though, historically and legally, is a very particular and specific thing. It's an interest rate limitation, and I know that because I read them all. You know, I mean, at one point, another empirical study I did a few years ago went and read all 50 state usury limits, and we know what those are, and that's not. The universe of potential price gouging is not the same as the universe of interest rate limitations in our law or in the history of usury laws. But if you look at the Bureau's enforcement work, and I think also the one UDAP rulemaking that the Bureau has announced is the one that you focused on, the Payday rule. And I guess, you know, fair disclaimer, I mean that's obviously something that I worked on, but the Bureau has been reticent to list excessive pricing as a justification for UDAP action, either in supervisory highlights, in the rulemaking, or in enforcement actions. And it seems to me that is internalizing or taking too broad a view of what a usury limit is. A usury limit is just a prohibition of an interest rate above a certain specified level, and it's nothing else.
Do you think that when a consumer is willing to take a high-cost loan, that's indicative of them being inherently financially fragile, and maybe a red flag that they are more prone to being taken advantage of?
Well, yes, Nick, I do.
So do I.
Can I ask a follow-up question on that? See, when I read the abusiveness standard, I see taking a reasonable advantage of. I think of I think back to, say, Elizabeth and Orrin Bargill's article, Making Credit Safer. I think of the company knows more about you than you do, sort of taking advantage of them via behavioral economics. We know your biases. We know how you're going to react to that, and that's why we're setting up our products so that the benefits are up front and the costs are hidden for a while.
Well,
Do you don't read it that way at all?
No, it's not that I don't read it that way. It's just that, so take. I mean, there are 4 different prongs, but just look at the third one, the B2, which says unreasonable advantage taking of a consumer's inability to protect their interests in the selection or use of the product. I think the behavioral piece, the process piece. So if we're likening the abusiveness standard to unconscionability, which it seems like it's a very similar idea, that the process part seems to me to be built into the inability of the consumer to protect their interests, at least with respect to that prong. It doesn't seem to me that unreasonable advantage taking is limited to only sort of some behavioral process. So, I don't disagree that is clearly something they were talking about, but also, Senator Warren and Professor Bargill also, highlighted payday lending as a particular example of an exploding toaster kind of a product. And the thing that I think that if you go back and look at that article, they were concerned that the loans were expensive.
One of the things that I've heard consequences of the new payday rule is you're basically going to guarantee putting out of business small payday lenders. Someone who maybe has 4 or 5 payday operations in a state, things like that. And with that model that you showed from Missouri up there is basically going to guarantee the only product available for consumers are going to be national major organizations that can spread out their risk. Is that better for the consumer to have everything controlled by national companies versus smaller mom and pop organizations that actually get to know the consumers?
I don't agree that this rule will put out the mom and pop businesses out of business. It's yet to be seen. But nationwide, in any given state, about 30% of the stores are owned by operators that have maybe 4 or 5 stores. What we saw when we looked at Colorado, which in 2010 changed their state law in ways that look somewhat similar to what the CFPB is pushing this market towards, Some of the small guys went out of business. Now about 25% of the stores in Colorado are owned by those types of smaller businesses. So there's a 5% drop in their market share. The CFPB rule is a lot more burdensome on the lender than the Colorado law was, so it stands to reason that it will be harder for lenders generally to comply with it. But by the same token, that means there's a lot bigger opportunity for data providers and solution providers to come in and offer a turnkey solution for complying with the ability to repay. And I have no reason to believe that the smaller lenders won't be able to do that, to use those services.
So I'll just chime in on that too. I mean, that sounds like industry propaganda to me, frankly, and that it depends on what the loan product is that they're offering. So if you have a small business that is willing to make a 5,000% interest rate loan to consumers that's a longer duration loan or an open-end line of credit that doesn't take a leveraged payment mechanism such as a pre-authorized ACH debit or a lien on the borrower's vehicle, the proposal, and again, it's not a rule, it's a proposal, the proposal is silent on that. So the notion that you couldn't run a business doing that is just facially false, right? If you're willing to make unsecured loans to consumers and feel like you can underwrite with that and can collect those debts based on the consumer's individually authorized voluntary payments, the regulation simply does not touch you. And so as soon as they figure that out, I don't see what the compliance costs or challenges are for that type of small business. And those loans are legal in many states, including my own home state. So, and there are businesses in my home state that engage in precisely that type of lending. And in fact, some of those loans were cited in at least one component of the Federal Register. But that being said, if you're going to try and make loans that do take leverage payment mechanisms, and you want to try and fit into the framework of the regulation because that leverage payment mechanism is so important to your collection strategies as a businessman, it is the case that attempting to verify that the borrower can repay the 600%, 400% interest rate loan is going to be more complicated and burdensome than it was in the past.
I have a question for Angie, since we have a little more time. I remember when Jean Bracker presented that paper 2 years ago in draft form at the Symposium for Bill Whitford. And so I was wondering, do you think as time went by, she would continue to be as optimistic as I remember her being at the Symposium about the CFPB in light of what she was talking about? Like, would she write the same paper? Would you write the same paper?
I think she would about supervision, right? So yes, it seems that the supervision process appears to have continued as we wrote about it. And so I think, yes, I think she would be disappointed on the lack of abusiveness actions. And she was one of the, not to come back to this, but she was one of the people who influenced me in thinking, oh, right, this is behavioral economics. This is stopping seduction by plastic, for example. But, so I think she would be disappointed that it hasn't moved being used at all, certainly, or being used very often.
Do you think the examiners are doing more abusiveness enforcement than the enforcement office is?
We don't know, right? We don't know. No, I think those are two separate issues. When I bring them up, I have to bring them up as two separate issues. I think she'd be excited that the supervision process is continuing, but that she'd be disappointed about abusiveness not appearing to be a major part of it, at least in public actions.
Jim?
I was wondering whether or not you all thought that the CFPB is not the correct body to implement payday lending rules, because I guess precisely because Colorado seems like a success story, but it's only a success story because it deals with the problem of high prices, right? And the CFPB doesn't have the ability to do that. And so maybe should it step back, not regulate payday lending and let states that have, or should we, I guess, alternatively get rid of that usury limitation? I don't know, but in light of that limitation, to me it sounds like both of you are saying that price is the problem, and it doesn't seem like that's going to get solved.
I am emphatically not saying that price is the problem. Right. It is a problem, but it's not the problem, and it's not dispositive of anything. you need several mechanisms in place. You need an affordable payment, you need a reasonable time to repay, you need a fair price. A price that is not unnecessarily high in order to make the credit that you want to be made available. Colorado is a success story because they wrote a comprehensive law that incorporates all of those things. The CFPB can't regulate price, but they can regulate those other things, and they could impose a different set of rules about affordable payments and reasonable time to repay, and the presence of upfront origination fees that are fully earned and so on. And they could really improve and clean up this market, and I think they're within range. I don't think they've got there yet in their draft, but I think if they made some key adjustments, they would dramatically improve this market. And I think more importantly, at the end of the day, they could open up this market to be a much more level playing field among all types of lenders, which I think speaks to the right role that the CFPB could play here. Focus not just on whacking the state licensed bad guys, if you will, but make a rule that banks and credit unions can use as well. Get into this market. They have the ability to make loans profitably in this space at 6 to 8 times lower cost. That's really what, at the end of the day, could save millions of people billions of dollars, is if the banks and credit unions where they already have checking accounts were offering them a better, lower cost alternative. And the reason, in a nutshell, that's not happening more today is that there's no federal guidance for it. And the lack of guidance is keeping the banks and credit unions out.
I'm just responding. I'm a huge fan of Nick and the Pew Charitable Trust's work on payday lending. I mean, the resources that they've had and the new empirical insights that they've created are just astonishing. It's just wonderful scholarship. Nick is, without question, among the very foremost thinkers on this in the country. That being said, I sometimes feel that you are a touch unrealistic about the legal risk associated with that rulemaking. It is the Bureau's first rulemaking under the UDAP authority, and the Bureau has to produce substantial evidence under the APA, the Administrative Procedures Act, that justifies any of the things that it designates as being an abusive, deceptive, or unfair practice. That has to be empirically grounded, admissible evidence where experts and whatnot can testify to it in federal court. So some of the other things that you're talking about, other potential levers that the Bureau might use, recall that each of those levers has to be justified based on empirically demonstrated sort of evidence. And that being said, I also don't mean to defend unequivocally the Bureau's proposal. There's a lot of I guess I learned that sausage also gets made in the executive branch sometimes. But I will say one different distinction with Colorado. You're right that Colorado, in its complicated framework, has a price limitation, but a lot of other things too. But if you take the price limitation out, then I'm not so sure that those pieces continue to function together. It's almost like taking the bottom of the bucket out or an essential piece of the framework that they have. And once if the Bureau doesn't have the thing that binds it all together with a price limitation, I think it actually is a little bit tougher than maybe you suggest to get all the pieces to work together, particularly in light of the litigation risks associated with the evidence having to justify. So all of those mechanisms. So when you put all those pieces together, it's an extremely difficult rulemaking.
No doubt, but saying that a policy can't work if it doesn't have a price limit is tantamount to saying that the Bureau can't solve this problem. And I don't think that's true. And if you don't think that the Bureau can't, if you don't think that's true, then the logical conclusion is maybe that the rule will be so difficult and the enforcement overhang will be so scary that you push the lenders out of this market, which also is not going to happen. So, I mean, the rule allows lenders to take a quarter of a person's paycheck. It writes it baldly in the commentary of the rule. That's not a great improvement. And the point I wanted to make, in terms of the legal risk here is the cost-benefit analysis that the Bureau does have to prove includes consumer benefit. And if the consumer benefit can't be shown in a great way, yet there is as you said, and I agree, there's a very severe regulatory overhang, a cost that's associated with this rule. That cost-benefit analysis becomes really dangerous. And I think if the Bureau made its rule stronger to promote better consumer benefit, it has a stronger case against the payday lenders lawsuit.
So I'm not going to defend the Bureau's rule on this issue. So I was merely raising a point that it's not. It's not. You have to recognize that there are substantial legal risks with some of the things that. But I'll stop. Excellent feedback.
So we have 3 minutes left. Maybe we'll take a couple comments or questions and then finish up the panel that way. So Mirsa, and then David, and then Paige.
So coming at this from the bank angle, because that's where my work has been focused, there's the idea that this is driving out the credit unions and the small banks that are doing these loans, I think is another one of those industry myths. Very few credit unions are in this market. There's about like 100 CDC, right, community development credit unions. Only 5 of them actually engage in small lending. The credit unions that I've studied, the small loans that they consider somewhere between 10 to 20, like the new Goldman Sachs sort of Marcus product. This is not, they're not doing payday like. I don't know of any banks that want these sort of loans. And so I think, I don't know, do you have any other data research that shows otherwise, that they are actually engaged in this?
Well, the federal credit unions are allowed to lend at up to 28% under the payday alternative loan program, but that market is, I think you're correct in suggesting, quite limited. I think it's under $100 million a year nationwide, which is really quite small. That being said, before the Federal Deposit Insurance Corporation and the Office of the Comptroller, issued a regulatory guidance on bank payday loans, or what do they call them, deposit advance products. That was a more robust market. Some of the not just large CFPB banks, but the largest banks, at least one of the largest banks, was offering that product to millions of consumers. So they can get there if they're allowed to do so. But now the thing going forward that's going to be tricky for them to sort through is how they can comply with both the Bureau's ultimate rule once it settles on it, if it does. Of course, again, it's just a proposal, as well as the FDIC OCC guidance. That's going to be a complicated overlay. And add to that, now the Military Lending Act goes into the new and improved regulatory version of the Military Lending Act goes into effect. I think it's next Monday on October 3rd. And that's another sort of segment of the market that the banks would have to sort of either carve out or deal with in some way. So I think it will be logistically difficult. And my guess is that the banks are not going to be willing to invest the sort of load in the capital. They would need to build a compliant, robust system until the Bureau's rule settles the market.
Yeah, and the rule would have to be, I think, a lot more clear in terms of what was expected in terms of monthly payments, and they would have to have an ability to automate a lot more than this rule as proposed would allow, because they do pre-screening of customers, and they automate the offering and the origination of these loans, because they can't make a loan for a fair price unless they only spend $2 or $3 or $4 originating it, and the only way to do that is automating it. There's just no regulatory path for them to do that right now, which is part of the point. And I think if the CFPB offered that streamlined path, that would go a long way to helping banks and credit unions get in with lower cost loans.
So we're out of time. If we want to stay here for a little while longer, we can continue talking. Otherwise, 15-minute break and reset for the next panel. Come down to continue the conversation in the meantime.